Excellent. Welcome everyone to today's webinar, Integrating Income-Generating Community Investments into Retirement Portfolios. This is a new educational workshop series that's sponsored by Worthy Property Bonds and designed to help individuals and advisors learn more about the alternative retail finance space. For those who don't know Worthy is a leader in utilizing the modern regulatory landscape to bring income-generating products to the masses. Hope you check them out at worthybonds.com. So today's session will explore why public securities are not providing enough diversification, how community investing differs from traditional public market investing, how to identify opportunities through platforms and regulatory frameworks, how to evaluate community-based investments, how self-directed IRAs are becoming very useful in accessing community-based investments, and how to understand the income potential and liquidity considerations that are associated with community investing strategies. So before I bring on our expert, amazing speakers, just a couple of housekeeping items for you. First, I want everyone to know that this webinar is for educational purposes only. It should not be construed as investment, legal, or tax advice, or as an offer or solicitation to buy securities. Now, what we're going to do here for this session, first of all, you'll see actually on the right part of your screen, there's a place where you could ask questions. Feel free to ask those questions as they come to you, but know that what we typically do is save the Q&A for the end of the presentations. So as far as format is concerned today, I am going to start off with a just brief overview to provide you all with on why alternative investments and community investments in particular are becoming so much more integral to modern portfolios. Then we're going to have Paul Lovejoy. He's going to do his presentation, and I'm sure he's going to touch on this, but Paul has a really fascinating story. He actually, well, he'll touch on it, but he actually did a different impact investment for each day for 1 year. And he'll talk about his experience with that, I'm sure, and the returns he had. Then we're going to have James Jones come on, who is the self-directed IRA expert and guru in this space. He's really credited with the first to really sort of bring all of these kinds of opportunities, especially in the crowdfunding space, to the, basically that the create that introduction to, the crowdfunding space to the retirement space through self-directed IRAs. So we definitely have got the experts on the line here. Okay, so I just want to start by letting you know that you are not nearly as diversified as you think you are. There are millions of Wall Street products that are offered today, and they are built on just 4,300 listed stocks. Now, that may sound like a lot, but it's really not. And, when I really got started in the business in the 1990s, there were like 8,000 publicly traded stocks. So now we're already down to, practically half. And that keeps diminishing. And what's even worse is that as the number of publicly traded stocks decline, the market capitalization of these companies are continuing to rise before they get to the public markets. So that means that the whole concentration of growth is happening long before these companies ever get to the public markets. And just to give you an idea, Intel went public in 1971 at a $53 million market capitalization, raising $8 million on its IPO. Intel just the other day reached its all-time high just recently, and the $1,000 invested in Intel back then, has appreciated substantially. And if you even look at, Intel's market cap now, I think it surpassed 400 billion. So that from 50 million to 400 billion, that is all in the hands of retail investors and retirement portfolios where they should be. Compare that to, companies that go public today already in the billions, even sometimes hundreds of billions, or even look at the AI universe right now in the venture capital space. These companies are fetching, in some cases, over $1 billion on a seed round. So, who knows what these companies are going to be when they finally make it to the public markets. So that's why, it really is important to look outside that publicly traded universe. And not only that, but we talk about these, 4,300 listed companies that we have today. The reality is that only about 250 of those actually have a, decent daily trading volumes. And most portfolio managers and mutual funds really only engage with less than 1% of those listed stocks. It's a little bit, especially if you're really only, in a certain fund that is specialized. But, 0.7% to 2.8% of listed stocks is practically nothing. And in fact, less than 2% of U.S. funds hold more than 1,000 unique stocks. And those are just the mutual funds. When we talk about the index funds, it actually gets much worse, because just 10 stocks now make up 35% of the S&P 500. And even more astonishing is that 7 of those 10 stocks account for nearly 50% of the NASDAQ 100. So you think you're getting diversification by, being in a NASDAQ fund or ETF, or, as well as an S&P 500. You're really not. You're just getting those same old stocks. So that's one of the reasons why we've really seen the rise of alternatives. And, especially in the private credit space too. And we've seen, the institutions really shift towards alternative products, whether it's alternative, private credit or private equity, venture capital, et cetera. They're all looking now for alternatives for that diversification. What's happening now is that the Reg CF, regulation crowdfunding, and Reg A+, and some more in the regulatory universe, the regulators, we have new rules that are coming out to really give retail investors now a chance to participate through some of those mechanisms. So we're seeing that happen. And at the same time, we're also seeing technological innovation happening behind the scenes that are making alternative products available to small investors, because they're making it possible for investors to invest in tiny increments, even as little as $10. That would have been unheard of 20 years ago. And the best part is that there are a range of wealth and tax strategies that can further reduce risks of community investing, while also creating powerful tax advantages for today's retail investors. And I know Jim is going to focus a lot on that. So with that, I'm going to put up Paul's presentation, and Paul is going to take over the baton. So here you go.
Well, thanks, Dara. Thanks for getting us started. And wow, yeah, the lack of diversification is truly astonishing in the public market, not what people think. So I imagine everyone here is here today because you want to retire in a world worth living in. So that means making a market return on investments that actually align with your values. Again, my name is Paul Lovejoy. I'm a licensed investment advisor specializing in productive crowdsourced investing, and I've evaluated well over 1,000 of these types of offerings. I'm here to share the good news, the bad news, and the hopeful news about using a retirement account for values-based investing. So back in 2016, I was scrolling social media when I came across a meme from a show called Mr. Robot. The show featured a corporation called E Corp, but the characters called it Evil Corp, and it's portrayed as like a comic book villain. I laughed, but then I had a thought. Publicly traded corporations aren't evil. Well, they're simply fulfilling their purpose, which is to maximize shareholder value. The system is doing exactly what it was designed to do. But that got me thinking about something else. When you invest in the stock market, you're not funding any business. You're trading ownership papers on value that's already been created. If you buy shares in, let's say, a solar panel company, you're not funding that solar company. You're funding whoever sold you those shares. Now, most likely it's some large institution, but it could be a grandma or it could be a cartel boss. There's no way of knowing. And prior to 2015, that was the only realistic option for a retail investor is the public market. Then the Jobs Act changed that, signed back in 2012 and implemented in 2015 for two main exemptions that allow retail investors to fund businesses that create real value. As Dara mentioned, there's Regulation A+ and Regulation Crowdfunding. Now, I personally wanted to know if investing through these two exemptions could deliver a strong market return with a diversified portfolio. So in 2024, I ran an experiment. Every day for an entire year, I made one productive investment. So did it work? The answer is yes. The portfolio now has over 500 positions across 20 platforms, including worthy bonds. So I know Dara mentioned impact investing. Well, I consider it more productive investing. And that's because it's important to me that my capital is going somewhere real, that's building something, funding operations or financing equipment. The worthy bonds, that fits that definition exactly. So when you're investing in Worthy, you're backing a private lender that funds small to mid-sized real estate developers. In my mind, I'm thinking a local boutique home builder, a community shopping center, and they're literally building things. And, that's great for the local economy. It's hiring trades, electricians, plumbers, keeping that money local and circulating, but it's also better for the broader economy because now our broader economy can stand on stronger local economies. And this is really important. So not only did I invest in worthy bonds, but I invested in solar microgrids, small businesses, and even startup companies, like Dara was talking about earlier with Intel. There was one company I invested in. It was called Invicta Water, which is now removing PFAS, these forever chemicals, and from municipal water supplies. And it's really great feeling to make money building things and solving problems. And the returns are real. Now, the numbers you see on this slide are based on cash flow generated, interest, principal payments, revenue share distributions, and realized gains. Now, these returns don't represent an IRR, and we'll get into that in a second. But for the first year, I was still deploying capital every day. So that return, as you can see, is 10.5%. Year two, this was after my experiment was done. Now it's just a mature portfolio, no new capital going in, and it's providing a 34% cash flow return. So that's the number I'd point to you as representative of what a seasoned portfolio of this kind can generate. Okay. So here's where the bad news comes in. When the experiment ended, I had hundreds of loans with no practical way to track them. And this is through regulation crowdfunding, through the regulation A, like a worthy bond. They structure the loans for you. It's just one entity that's giving you your return. But through regulation crowdfunding, you're literally funding each individual loan. So, and what was really difficult was that every platform reports this differently. And on top of that, the loans are structured differently. Some loans are interest only, some are fully amortized, some start interest only and then amortize. There are deferred interest structures and revenue sharing notes, and none of the platforms gave me what I needed to calculate a true IRR, an internal rate of return, which measures the actual performance of your portfolio, accounting for the timing of every cash flow. So I built one, a universal spreadsheet standard that any platform could adopt, and now has the support of the Crowdfunding Professional Association and is being considered as an international standard. Now, this isn't just a personal inconvenience I solved. It matters because retirement account custodians require standardized data reporting to hold an asset in custody. A universal spreadsheet standard is part of what makes values-aligned investing scalable and eventually accessible inside a retirement account at scale. Which brings us to today. Right now, the most accessible path for using a retirement account in values-aligned investing is through Regulation A pooled funds. That's the exact structure Worthy uses. And it works because the pooled structure gives custodians exactly what they need: pricing, reporting, regulatory clarity. The challenge is that the only retirement account that could hold these investments today is a self-directed IRA. A traditional 401k won't get you there. A standard IRA at Schwab or Fidelity won't get you there either. That's why I get to share this panel with a self-directed IRA expert, because the path exists. It just requires a deliberate step outside of the default system. So if retiring in a world that you want to live in matters to you, and I think it does, or you wouldn't be here, this is the path. The infrastructure is being built. Worthy is proof the structure works today. The self-directed IRA is the vehicle, and what we're building in the data and reporting layer is what opens the door for everything that comes next.
Amazing. Thank you, Paul. I'm going to switch gears here to get Jim on, and then we'll go forward with our Q&A.
Paul, thank you so much. That was absolutely fantastic. You are the only investor I know that has ventured into such a bold undertaking. So congratulations. My hat's off to you. We need a lot more folks like yourself in this industry for sure. And your observations were absolutely spot on about reporting, which is a necessary element for self-directed IRAs. So yeah, it is a headache and a nightmare for both the investor, for the self-directed IRA custodian that requires that in order to stay compliant with their state banking registrations. They can get in a lot of trouble if they don't have those, and as well our friend the IRS. So you have undertaken great work, much appreciated. So here we have a bunch of slides. I'm going to really not focus so much on the rules and regulations of IRAs in general, but what's really more specific and meaningful to this conversation, which is self-directed IRAs. Again, the usual disclaimers is that this is not tax or investment or even IRA code 4958 or 509A, which shows all the rules and regulations. We always refer you to the tax experts. I've been in wealth management over 30 years, and I have been in the self-directed IRA space for about the last 15 years. And the most important thing that we start with, and Paul did a great job of explaining that, so I can kind of just highlight again, an IRA, individual retirement account, was founded in 1974. And during that same time, in the language that the Department of Labor put together for individual retirement accounts, that same language exists. So self-directed IRAs are not something new in the last 10 or 15 years with crowdfunding. They were created. They're just a type of retirement account which will hold non-publicly traded investments. So as Paul had mentioned, your Schwab IRA, we know, can hold stocks, bonds, mutual funds, and ETFs. Self-directed IRAs literally can hold thousands of different assets. We might know things like crypto, things like gold we see on late night television. But the majority of assets in self-directed IRAs is really private equity, private debt, and venture capital. And those require the use of a self-directed IRA custodian. One of the things that Dara had also mentioned was public markets, the size and the growth of public markets. And we've seen that the alternative markets have expanded considerably. The self-directed IRA market, out of the 50 million individual retirement accounts in the United States, as nearly as recently as 7 years ago, were 1% of those 50 million IRAs worth about 12 trillion today. They're up to about 5% of those 50 million IRAs. And they're now worth, if we included other pensions and 401ks, would be over $50 trillion. Individual retirement accounts, about 15 trillion today. So just touched on that, the size of the market. So they're still relatively small. Again, 3 to 5% of those 50 million IRAs worth about 12 to 15 trillion. Still relatively new. And still, what we're going to kind of touch on in a little bit is the process and the technologies, which is still lagging. It's certainly behind some of the newer large wealth management firms today, some like Robinhood, Betterment, that are utilizing technology. Self-directed IRA custodians are still a little bit behind the curve. And I know Paul, in our prior conversations, can certainly attest to that. Toward the end, I'm going to just kind of highlight some workarounds that might be useful. So again, just to reiterate, no different a self-directed IRA than a regular, other than the assets that they hold. They do offer the same kind of individual retirement accounts, which are known as traditionals, Roth health savings accounts, Coverdale, SEPs, and solo 401ks. Again, very briefly, a traditional IRA is going to be able to, you're going to make contributions. I'll touch on those amounts shortly. Every year, you may, depending upon your income brackets, get a tax deduction for that. The thing to know with the traditional IRA is that you will, at some point in the future, today, this year, the age is 74, you will have required minimum distributions, meaning at age 74, you must start taking distributions. You may, again, get that tax deduction if you're not making in excess. Typically, the range is about $180,000. The Roth is certainly something that most investors try to move toward. Relatively new since 2004. You do not get a tax deduction when you contribute the annual amount to a Roth, but you will never pay taxes. There is a 5-year holding period on the gains of that, just to be aware. But without getting into the weeds, after that holding period, the idea, and there are some very famous investors that have grown a $2,000 Roth IRA into a multi-billion, about a $5 billion Roth IRA that you will never pay taxes on. So something I heartily encourage you to talk to your financial advisor as well as your CPA. A health savings account, think of it as a Roth IRA that is used toward those items that would qualify for health savings plans. And there's a long description, but they're basically related to healthcare, medications, and some other health-related everyday products. Solo 401ks are great if you are a gig worker. You therefore don't have access to a retirement plan. And Dara has talked in great detail about the inequities if you're a gig worker, which makes up about 40% of the workers today. So you can create your own solo 401k. SEP is even a better version. Think of it as a pension plan for the self-employed. In a second, I'm going to touch very briefly on the amounts that you can contribute, but this is really kind of like a retirement account on steroids. You can supercharge the amount that you contribute to a SEP IRA, and it comes right off the top of what you earn. A Coverdell account is an educational account, also like a Roth. It distributes tax-free for the amounts that you put in and spend on education qualified. Real briefly, traditional and Roth IRAs this year in 2026, you can contribute $7,500. You do have a catch-up provision. Health savings accounts, $4,400 annually if you're single, $8,750 if married. Coverdale, unfortunately, is only $2,000, so that will buy us some books at best. What's interesting, the solo 401k, like a corporate 401k, you have $24,500 with a catch-up to get you to $32,000, but with a SEP, $72,000 a year you can contribute. Obviously, that's if you're making enough money to cover that contribution. Typically, it's capped at about 20% of $200,000. Those limits are increasing this year. But if you think about that kind of compound return that Paul is getting, and you do that for 10 years, $720,000 plus that kind of return, that is some significant money. So these are things, again, you certainly want to talk to your financial advisor as well as your CPA. But again, when you look at some of these alternatives, like considering worthy bonds in your portfolio, it really can turbocharge your retirement savings. Getting started, this is a little bit still, when I talked about the industry is somewhat antiquated. This is what I'm talking about. One is process, and then the other is pricing or fees. So just a very quick differentiation here, going back to the Schwab scenario. Either an advisor, which makes their money on charging you basis points, maybe 1% of your assets under management, or if you're working with a brokerage firm, oftentimes they will have that same model. Other times they might take a little piece of that transaction. And with the self-directed IRA custodian, they do neither. They're not making any kind of fees because they're not giving any advice. It's very important to note they're not allowed to give advice. They are not fiduciaries. So you can't go to a self-directed IRA custodian and say, hey, what do you think about these alternative assets? I heard this guy, Paul, talking about different kind of opportunities here. They are not allowed to give any advice. So that's one thing to keep in mind. 3 steps, very briefly. One is to open an account with a self-directed IRA custodian. Today, that is often done online. It can be a relatively quick process, 5 to 8 minutes to open that account. The second step is the cumbersome process. It's actually moving those dollars from another retirement account we call a resigning custodian, like a Schwab, a Merrill Lynch, an E-Trade, a JP Morgan, Betterment, Robinhood. You're moving those retirement dollars to the self-directed IRA custodian. And so that's where it's very, very important that you do your due diligence, pick the right self-directed IRA custodian, and have a high level of confidence that they will be handling the transfer of your retirement dollars going from your resigning custodian, again, your Schwab, Merrill Lynch, E-Trade, to your new custodian. And one very important point here, this is where it is worth a little bit getting into greater detail. You want to do what's called a direct transfer, or a trustee to trustee transfer. Absolutely important. That's crucial to do so. So the money is going directly from your resigning custodian into your new self-directed IRA custodian. And it's going in the name of your self-directed IRA custodian. It is done electronically, being wired. What you don't want to do is an indirect transfer. Sometimes the nomenclature, the phraseology gets mixed and confused, but it can be known as an indirect rollover. Here, very briefly, the money is not going from custodian to custodian. It's going from the custodian to you in a paper check made out to your name. You do not want to do that. Number one, the Fed can withhold up to 20% tax withholding. So if you slotted a $100,000 investment, guess what? Only $80,000 is coming through. So now you're going to have to scramble to make up for that $20,000 that's being withheld, because the IRS is going to assume you're not going to deposit that check. You're going to cash it and spend it on a new car or something like that. So they're going to hedge their bets and withhold 20% of that. Also, you have 60 days to roll over that money and get it to you custodian. I can give you horror stories of people that they lost a check, got lost in the mail, the dog ate it, they sat on it, they forgot about it. Another family member got the mail that day and threw it out. Stories on and on and on where it doesn't get there. So that's probably one of the most important things to take away if you decide to work with the self-directed IRA custodian. Open the account, make sure you have a trustee transfer. And then the third part is just simply going on the sponsor website and telling them, yes, you are giving the self-directed IRA custodian permission to invest that money into this offering. That's the important point. They have to have permission to do that on your behalf. Rules that also going to touch on very briefly. It's really not going to apply in the world of investing into notes, into Reg A or crowdfunding CF opportunities in areas where you own physical assets, like a piece of real estate, like an investment property, a beachfront condo. You can get into issues of prohibited transactions. Won't get into that today, really, but know that although you own the IRA, technically the IRA owns the asset. So if you ever invested in a beachfront condominium, you and your family, up and down, your grandparents, children, grandchildren, you're all prohibited people. You cannot get any kind of direct or indirect benefits like using that beachfront condo. You can't stay there. One thing that can be a prohibited transaction in this world, let's say you invested into some subordinated notes, you were earning 10%. The income that you make, and I see this happen all the time, people think, okay, I'll use the money in my retirement account, and then I'll take the interest that I make and I'll put that in my checking account and I'll use that as expenses. No can do. Again, the IRA owns that investment. So any capital appreciation or dividend or income or distributions that come from that investment sponsor or investment offering, they have to go right back into your IRA. That would be a prohibited transaction. So prohibited people, prohibited transactions. Custodians, they're out there. Certainly if you Google self-directed IRA custodians, you'll find those, but companies like Equity Trust, Millennium Trust, now Inspira, Alto IRA, Entrust, Advanta. These are all examples of large custodians that have been in the business for many years. Again, we really kind of touched on this. What do I do? Again, the best thing is to work directly with a self-directed IRA custodian, establish a relationship with them. These are the different kinds of investments, once again, that we mentioned: community investments, real estate, private equity and debt. Real estate related to private equity and private debt makes up about 70% of the assets in a self-directed IRA. just FYI. So very common asset. One of the things that works very well is if you have a Roth IRA account and you have an investment that's spinning off income, wow, there you go. So the money that you are allowed to take out of the Roth after that 5-year holding period, you're getting tax-free. So once again, talk to your accountant, but think about it. If you're making 5% or 7%, but you're doing it in a Roth and it's coming out tax-free, kind of like a municipal bond, right? So you have to factor what your real after-tax earning is. That's going to bump it up equivalent to about your tax bracket. So important to know. Key takeaways, and this is probably the last one or two things that I'm going to mention to get into a little bit, and again, in and with respect to Paul, what he found. Keep in mind, so we touched on the pricing models of a self-directed IRA custodian. Again, they don't make asset under management fees of 1%, 2%, 50 basis points. They don't make a piece of the transaction. What they do is they make their money on fees, and the fees are not cheap. So fees can be as low as $100 per asset per year. I've seen some of self-directed IRA custodians, their fees have come back up in the last 2 or 3 years. They can be $300-400 per year per asset. So if you think about it, if you're doing math, if you're investing $500 and sticking your toes in the water for a small investment, but it's costing you $400, not only are you not making any interest, you've decimated your principal. So that would not make sense. There is a workaround, but the workaround really makes sense if you're going to do something like what Paul did and have a lot of investments that make it worthwhile. And it's called a checkbook IRA. That's just an expression. There's no legal definition of that. All you're doing is you're opening up a self-directed IRA. You're creating an LLC that is going to be a single member LLC that is going to own the IRA. Now you have an LLC that owns your IRA. You can go down to the local bank, show your local bank your LLC documents, open up a business checking account, and there you go. You now have issued a checkbook as well as a debit card associated with that. And so your only fee for that checkbook IRA, well, 2 fees, except actually, let me clarify that. There'll be 2 fees with the checkbook IRA, and this is where you have to crunch the numbers and do the math to see if it makes economic sense in order to do this. So you'll have that $100 to $400 annual fee for the self-directed IRA custodian to hold the LLC or the checkbook IRA. And then you'll also have the state registration for the LLC. It can be as cheap as $60. I've seen them over $200, but again, do the math. So combine those 2 fees, you're looking at $800 to $1,000 realistically after all is said and done. But if you're going to be making multiple investments, and they might be on a smaller side, you're not getting charged that fee by the custodian. It's already under the fee of the LLC. So you could make 20, 30, 40, 50 investments, and it's only going to be that $100 to $400 for the LLC. That's where it can start to become efficient. But again, as we heard, that's where it's really important for reporting purposes that you're able to track those. So that would be my one other takeaway for you. Please, if you're considering a checkbook IRA, you probably want to hire at least a paralegal, if not an attorney, to help you with some of the basics. And make sure your self-directed IRA custodian will offer the checkbook IRA. There's a few out there that won't. Lastly, also again, to Paul's math, boy, the rule of 72, we've talked about that for the last 30 years as an investment advisor. So if you want to figure out how many years it takes to double your money, take the number of years and divide it into 72, or take your return and divide it into 72 to take how many years it can take. And again, it's not necessarily, and I have to be careful here not to put on my advisor hat, but just speaking anecdotally, It's not in the first year, the third year, the fifth year, the 10th year of compounding that works. It's really 20 years, 25 years, 30 years that you start to see the incredible compound. It's not $10,000 doubling in 7, 8, 9 years. It's $100,000 doubling. It's $400,000. It's $800,000 in that 30th year that it doubles. So it's not timing the market, it's time in the market. When I worked in the Merrill Lynch Trust Department with a lot of wealthy people, they weren't so concerned about getting 6% or 6.5% or 7%. They wanted it to be tax efficient. They wanted it to be a solid investment with good returns, and let it ride and let it sit there for as many years as possible. Again, got to be careful not to give advice there, but think about that long-term investment strategy now with alternatives. And so again, my final point, and I'll hand it back to Dara, is that really with a retirement account, it is a much different strategy than in your taxable accounts. So I'll go back to almost one of the first things that we talked about. You talk about redundancy. For 30 years, I've seen people hold almost the exact same portfolio in their taxable brokerage accounts as they do in their retirement accounts, their 401ks, IRAs. So when I sat through the decimation of 2000, 2001, when I sat through the decimation, especially 2008, 2009, where a lot more people, 2000 you had .coms, but that was 25% of the market. In the meltdown of 2009, 75% of investors had their money in tech stocks, which took up to an 80% drop. 80% drop in their taxable money, 80% drop in their retirement accounts that were the same redundant investments. Ouch. 2015, 2016, they were back to even. So again, go back to your financial advisor, go back to your CPA with a strategy about how to diversify these different kind of alternative assets in your retirement accounts. Thank you so much. Dara, back to you.
Hey, Dara, I think we're on mute.
Yes, thank you. Great. We'll jump into some Q&A now. So feel free, anyone has questions, please put them in the chat box to your right. But let's start with you, Paul. I think I would say one thing that a lot of people are wondering is, how do you even find these opportunities? It's not like, they're in the public market. So how difficult is it to find these opportunities, and what's the process behind that?
Well, yeah, especially when I started out, it's not easy. It's not like, the mainstream financial press covers crowdfunding. They don't. So it is different. And the other hard thing is that a lot of these regulation crowdfunding portals, they not only have to attract buyers, but issuers as well. So and a lot of them, have, shoestring budgets. So they instead focus more on the issuers, because the issuers then could bring in, the buyers through meta ads or whatever you have you. But how I did it was I just kind of searched, I just kept on looking for these things. AI now makes it a lot easier to find. You could say, I want to, what are some regulation crowdfunding? What are some regulation A pooled funds out there? So you could do the research. But I'm sure there are things that I don't even know that exist, and I'm looking for it. It is a real tricky thing. But I was spending every day for an entire year searching for this. So if you put that kind of effort in, you're going to discover a few things. But right now, there's you have if you're looking for pooled funds, you got Worthy. There's also C-Note if you're interested in big impact investing, underserved communities. You get a lower return, but Yeah, tons of impact. There's also real estate REITs that are set up as Regulation A structures, and they provide great, returns. One of them, I got 12% still. Now it's itching up to 13% on one of these. So there are some great opportunities with that. Also, I've actually have now a portfolio of single family income properties because all it takes is $100 to get into one of these properties, and now I have a whole portfolio. And one of them is actually I'm a Stranger Things fan. The Netflix show, if anybody's out there, I love the show. I actually invested in the buyer's house from Stranger Things. It has all the Christmas lights hung up. It's the actual house. And I got to say, that one is gangbusters performing. Let me tell you, it has been booked since that. And all the investors were making good money off of providing real value from people. And you can see, I can go into Airbnb and see if it's booked right now. That's verifiable. And you can't really do that in the stock market. You can't verify some of this stuff. So just going through this whole year has shown me oh my gosh, there is so much out there. And why restrict ourselves to just 10 stocks? As Dara was saying earlier in the presentation, here's the crazy thing. The industry actually celebrates this. There's a moniker for these 7 stocks called the Magnificent Seven. I mean, that blows my mind that this is celebrated, which, it shouldn't be. So yeah, it's hard to do, but once you start looking, then you're going to find.
So, and then what happens next? So that's wild with the buyer's house. So, I mean, that's a place where people could go for vacation rental. Is that what they're using it for?
Yeah, exactly. It's on Airbnb vacation rental. It's 20 minutes outside of the Atlanta airport. So people end up staying a night or we were layover and we decided to stay at the buyer's house. I mean, it's wild. A really cool setup. Yeah.
That's wild. Now, once you find these opportunities, then the next step is obviously doing due diligence. So, I mean, how, important do you think it is for people to learn how to do due diligence? Should they come to you for help with due diligence? What are your thoughts? Because I mean, it could take someone all hours of the day just to do the due diligence, even after you find an opportunity.
Yeah, well, I do teach due diligence, and I don't charge for that for the general public. If somebody actually wants to hire me as a financial advisor, I'm very selective, and it probably won't make economic sense for you to hire me unless you have around 600,000 in investable assets. But you can go to my website, stakeholderenterprise.com, subscribe to my newsletter. I'm open about it. I share exactly how I break down these investment opportunities. And I got to say, the debt ones are a lot easier to do. And worthy bonds, I mean, it's a lot because it's only one offering circular that I have to look at and digest. And then I actually also use AI to help me I don't use AI to do the due diligence. I use it to organize my thoughts about how I should proceed looking at it. Then, because during the conversation, I'm like, oh, did I check their past history for, operating history for the last 3 years, or did I do the whole 5 years? So I'll ask these questions. But it's all learnable. All of this, the loans too, you're looking at the debt service coverage ratio, which isn't that hard. And because it's public, regulation crowdfunding, all of the filings are public. So you can take a look at the company's financials, all of that, put it into AI, go through it. By the way, AI will always say this is so risky because look at these offering circulars and these disclosure things, and it has pages of risks. Investing carries risk, but a lot of these are written for lawyers more so than people. And you have to, when you're doing the due diligence, you have to understand that, okay, yes, there is real risk happening here, but how much is this for lawyers and how much is this for like actually educating me on risk? I think that's an important part when people are talking about due diligence. But here, another really cool thing is you can go on to Yelp and do due diligence on some of these smaller companies. Now, I did a lot of small business loans and in restaurants or even brick and mortar, athletic, retail, apparel, all kind of stuff. And you go on there, you look at their Yelp reviews, and you can see, oh, wow, there's 4.3 stars with 163 reviews. And you can kind of go down there and see, look, oh, is this a systemic problem for their low scores? Or is this like maybe just some kind of angry person who wants to leave a bad comment? So the due diligence, yes, the equity takes a lot longer, but the loans actually don't take that much time, especially when you practice it a little bit. I could do due diligence on a loan now maybe in 20 minutes. Now, another thing that's great about these crowdfunding things is during my due diligence process, I have questions. And so you can go on to these platforms in the comment sections. They want you to ask questions. So I'll go in there and say, oh, well, how many people have you are already licensed to use this product? And then they'll answer and we're like, oh, now it makes sense. And then I can make a choice. And that's another signal. If they take days to respond or don't respond at all, that's a huge signal for due diligence. You want someone that's engaging. So going through the process of doing this it has shown me so much of how to approach it, how to do it, and how to explain it to other people in a way that makes a lot of sense.
So, it's interesting, just to put a fine point on your comment about risk. So interestingly, and we use the example of Intel's IPO earlier in the presentation. Intel's IPO prospectus was 38 pages. There were 0 risk disclosures. Today, an IPO prospectus is like 400 pages, and like at least 40 pages alone are just in risk disclosures. So it's a great point. And here is a company that returned, hundreds of thousands of % to small retail investors. So amazing stuff. We're almost running out of time, but Jim, I want to kind of conclude this with you talking about the how difficult is it for investors if they want to use a self-directed IRA? I mean, how could you help them really kind of navigate this landscape? Whether it's doing due diligence on which custodians to go to, or strategies around that. I mean, how could, especially, I mean, are you serving as a guide sort of to help people sort of navigate that world? Talk a little bit about that.
Yes. Yeah, absolutely. So once again, for the last 15 years, I've been not only helping the business or sell side of the business, working with platforms, but also directly with the retail investor, to help give them kind of a white glove service in order to help them navigate those 3 steps. I do have several books out. One of them probably most appropriate would be the workbook, which gives you step-by-step guides on exactly what you need to do, as well as the pitfalls where you can run into trouble. Certain things, believe it or not, like when you have to use or submit, some custodians are still requiring a driver's license photocopy. Silly things as having it in color, so it's clearer versus black and white. It's the picture doesn't come out clear enough. And so that can get you into 2 or 3 week cycle in and of itself, just to get your driver's license right. So there's lots of these little things that you need to be aware of. Another great example is when you're sending the transfer document, you want to send that to the transfer department of the resigning custodian. You don't want to send it to your financial advisor. Hard to believe, but now and then we have situations where that financial advisor is going to be shipping a couple $100,000 out the door, losing under management. And so that might go into the bottom of a pile on the desk, and that can sit there for weeks to months. We've seen those. So little things like making sure you know where to send the proper documentation. It's important to know.
Yeah. So my two favorite quotes from, I think, this session that I just love. I like Paul's quote where you said, you can make money by building things and solving problems. I love that. And then Jim, I love your quote about not timing the market. It's about the time in the market. So to take two takeaways, I love both of those quotes. It looks like we're getting to the top of the hour here. So I guess, for everybody else that's out there, we will send a follow-up. This is being recorded. You'll be able to watch it again, take notes. We'll be sending a follow-up with Jim and Paul's contact information. So if you want to get in touch. And I'd like to just end by saying thank you so much for taking the time today. And really providing your insights and expertise, and to thank Worthy Bonds for putting, these educational workshops together, because I think this is a really great service for retail investors, and this really will do something to democratize the investment landscape. Thanks, everyone.
Thank you so much.
Thank you.